Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at passiveinvesting.com. And I'm so excited you have joined us today. We do this show live every Tuesday to help you learn the ins and outs of passive investing so you can go into your first or next deal with confidence. And so if you haven't done so already, make sure to check out passiveinvestingwithwhitney.com. When you go to that website, you'll get a form. And when you fill out the form, you get access to my calendar. We can talk all things passive real estate and really dive into how this can be an amazing way to turn your income into long-term wealth. So check out passiveinvestingwithwhitney.com. Also, you get priority access to our open deals, and you get to see all these wonderful educational opportunities with our master classes and boot camps. Now, today we're actually here to learn about preferred equity, what it is, why it's important, how to invest in it. And I am joined today by our Director of Investor Relations, Rob Gallo. Rob, welcome to the show.
Hi, Whitney. Thanks for having me on. Really excited to be here.
Yes. Well, Rob, for those people who have not met you before, give us a 60-second download on who Rob is. How did you get into this space?
Oh my gosh. Okay. So as Whitney kind of pointed out, I am the director of investor relations here at passiveinvesting.com, but I have not been in real estate my entire career. I originally, and I feel like honestly, Whitney, there's a lot of people that are in kind of what we do now. And we're like, oh, well, I haven't done this the whole time. So my before career, I was a consultant. And I did that for 18 years. But at the same time that I was doing that, I was doing passive investing at that time. I have still have some active investments, trying to kind of get out of those because, well, we all know those phone calls in the middle of the night, what they can be. But still have some Airbnbs that I have with my family. And then finally, I just said, you know what? I really want to be in this first time because it's my passion. And I made the switch about almost 2 years ago now, that I joined the team after previously, actually, Danny Rendazzo worked for me in consulting many, many moons ago. But I've been with him since he first started into the arena, and have been a passive investor with passive investing as well as a few other operators. And yeah, that's kind of how I'm here today speaking to you.
Well, you and I have kind of a similar journey because I didn't come out of the womb as a real estate investor myself. Excuse me. I mean, I started off living flipping and house hacking and then eventually scaled the single family rental portfolio and went, oh my goodness, what did I do? This is a little nuts. I mean, even if you have property management, right? If you are a high income earner, working a high level at your job, I mean, it doesn't even have to be high level. Like if you're working, then you realize if you start getting your own single family properties, yes, you're getting leverage and income, but you have another job on top of your day job. And then if you're married with kids, or not even married, but have kids or whatever, another passion project, yeah, now you've got three jobs, burning the candle at both ends, five times in the middle. That's why I love passive investing, is it helps me take advantage of real estate, um, get the returns, get the tax benefits, get the income growth, capital preservation even, but without that time involvement. That's what I'm trading for. Now, we talk all the time about equity investments, debt investments, but there is a sneaky little investment here, tier, that's in between the two. So let's dive in. Let's kick it off. What is preferred equity?
Yeah. So, you know, and I know we've heard preferred equity probably across the board. So if you've done any investing, there's probably people say preferred equity in stocks and other companies and things like that. For real estate investing, a preferred equity position is a class of ownership that really has a higher claim on the assets that if you go to sell, or even earnings, than a traditional equity holder. So for example, um, and, and and I like using examples, so bear with me. What preferred equity would be is that if you look at the capital stack, and what that means is on every one of these deals it's in syndication, you're probably going to have a loan, right? And that's kind of sitting in first position in the capital stack. And then you have common equity, which is, as a syndicator, you go out and you raise money from individual investors to actually put into that. So you've got that loan, and then you've got that common equity there. What preferred equity is it basically sits in between that loan and the common equity, so that if it's per distributions or earnings or even a sale, that preferred equity position is going to have a priority over the payout of the common equity. And that's kind of just, at a high level, because there's a lot of different preferred equity nuances out there. But at the high level, that's what we're talking about in syndications for preferred equity.
So as a limited partner investor, I'm putting my thinking cap on. I like debt because it gives me cash flow, capital preservation, but I don't get the tax returns. I don't get the equity bump. I like equities because it can help me grow my portfolio, but there's, as we've known in the past couple of years, a lot more volatility potentially with equity. Why preferred equity? Like, we know what it is, but why?
Yeah, so great question. And it really, a lot of preferred equity has kind of characteristics of both debt and equity in itself. Look at it this way. So I just took us through that example about that capital stack. Well, if you invest in debt, right, I think everyone knows, well, debt comes first. Debt earnings, like distributions for debt, as well as, you get paid back first, right? Where common equity, you're not getting paid back first. However, you do have that, if the actual asset itself increases in value, you get that value appreciation on that. Well, when preferred equity sits in there, it's actually sitting directly behind the loan, but in front of that common equity. So let's say in that example that I just gave, let's say that property was bought for $60 million, right? And $40 million was actually the loan, and 20 million of that was in the common equity perspective. Well, for some reason or another, and I know we'll get into some more of these reasons why people would want it in a deal, that deal just needs an additional $4 million. And they decide to go the path and say, hey, we're going to bring on a preferred equity partner or offer preferred equity in this deal. Well, that preferred equity of $4 million is going to sit directly behind the loan, so that when we sell that asset, the loan will get paid up first, then the preferred equity returns and capital is returned second, then the common equity. So it acts like debt a little bit because it actually has that preferred position in front of the common equity, but it acts like equity because it also can have some of that appreciation that is basically structured into the equity side of that equation. So it kind of has those best of both world pieces in terms of sitting in front of the normal equity, but also having that appreciation ability, as well as possibly there's tax implications, obviously, with depreciation and some other pieces. It really comes down into how it's structured on a deal, but it does take advantage of some of those other pieces as well.
So if I'm an investor and I'm looking at a debt deal, an equity deal, and a preferred equity deal, why would I want to consider that preferred equity deal? Like you've illustrated where I sit in the capital stack and potentially my security being in second position, but why the heck do I even want to do this?
Yeah, so I mean, there's a couple of reasons why you might want to consider it. I think first thing is that there's a lot of deals. In fact, a lot of deals out there today, right? That, let's say that example that I gave, those multifamily assets, it's been operating, but guess what? For some reason or another, it might need some additional cash, be it cash that's needed to maybe pay down the loan to meet a loan covenants for an extension, or finish a renovation, right? That they have a proven renovation piece, but they need an additional $4 million to really finish it and then get to that next valuation on that. So from an investor perspective, it's a good thing to look at it and say, hey, I want to get into this deal now so that I can have that, kind of debt / equity advantages to it. But also trying to get in so that, yes, I also have some, additional tax pieces that can allow for that. There's a myriad of other reasons that we would want to actually get in there as well. But kind of that's where I see kind of one of the real key places. I do want to say the other piece is that and we kind of throw this around, I think, internally a lot. When you're looking at a preferred equity deal, some people say that the common equity is a cushion, right? And not that that's supposed to say, okay, people that are in the common equity positions are, a cushion or a pillow or anything like that. But basically, if you are coming in that preferred equity position, when you do look at a liquidation or an exit or a sale, that preferred equity position kind of sits on top of that, let's say, common equity cushion. So that's kind of alleviating some of the risk that if, let's say, you do sell for less than the actual, the going in price, that as a preferred equity partner, you're going to get those returns and the capital back versus any of those shortfalls probably are going to hit on the common equity. Again, depending on how the deal is structured, but that's kind of just in general of why that might be the case.
Yeah, so what I'm really hearing here to kind of pull out like 2 or 3 points is that one, the preferred equity could give you a little bit of diversification. If you can't decide between debt or going in the equity, you think debt is too conservative, but the equity piece is just too, not your flavor right now in this phase in the market cycle, that the preferred equity could be a good option to diversify and take advantage of the second point, which is market forces, right? So, I mean, I've seen preferred equity deals in all phases of the market, but right now it's been, we see preferred equity on purchases, used to purchase properties, but also being used to provide that extra layer of capital to get the asset through its business plan. So we get the diversification, we get to take advantage of the market forces. What is the market giving us? We've been talking about that quite often for the last 2 or 3 months. The market is giving us some great opportunities, yet investors are so starry-eyed. I want to be in the value-add asset that gets X% preferred return, X equity bump. We got to look at what the market's giving us, and this is a great opportunity here. But also that priority and payout, right? So you get that security, of being in that second position. Now, before we move on to like how do you find a preferred equity asset and all the different ways that you should look at it, I want to ask a question. How does preferred equity actually differ from a promissory note? Because we've recently talked about that on the podcast too.
Yeah. So, let me explain kind of how they might be a little bit similar in terms of what that is. So typically when you're looking at a capital stack and be it in the PPMs of the note of the deals themselves or whatever structure that might be, a promissory note is basically listed as a liability, right? So when you look at a payout structure, inside of what that payout's going to be, it's going to be loan as the first thing, and then there's going to be liabilities that basically have to get paid in order for the deal to sell, and then in order for it to actually hit in the common equity spaces or even the preferred equity space. So a promissory note is very similar to the loan itself. It's seen as debt. It could be secondary debt written on the loan, or it could just be in a promissory note that says, yes, we promise to pay this back, but it's going to sit right behind the loan, where preferred equity is still considered equity, but sits behind those loans, that debt, as well as, any of those liabilities. On the flip side of it, a promissory note does not act as an actual equity share. When you're going in as a preferred equity partner, you're technically taking a percentage of the overall equity share of that deal. So you're going to qualify for depreciation. You're going to qualify for other tax incentives that actually being an equity holder in a deal is going to allow you for. Whereas a promissory note, it's going to just basically be taxed as normal or interest income when you actually get down to it. And that there's really no, sizable shares that actually equal out to it. So there's kind of nuances of detail, but think of it more as, actually an equity share versus a promise to pay you back your capital in your rate of return. And that's not even including what appreciation that you can actually achieve as being an equity shareholder, whereas a promissory note is usually just, oh, here's your 10% return and your capital back, and that's it.
Well, let's start getting into some of the mechanics. So what what should investors look for when assessing preferred
Mm,
equity, especially from the operator standpoint?
yeah. So I want to take one moment here because it just dawned on me that some investors are probably asking, like, oh, great, preferred equity. Why don't operators do that in the first place? So first, let me say, preferred equity is typically more expensive. The cost of that capital is usually above 10%. And what we've seen kind of in the market today is anywhere from 10 to actually 20%. In fact, I saw a fund started the other day that was saying like, oh, it's 20% that you're going to get. Well, that 20%, something has to pay. And it's, guess what? It's the asset itself. So when deals usually start, they don't necessarily put in that, yes, we're going to have some preferred equity. I think, as you said, Whitney, when a preferred equity kicks in, it's usually when, hey, we can't raise enough on the common equity. That deal just isn't sweet enough for some folks. So we're going to bring in a preferred equity partner. They're going to charge us a little bit more for it. Or if it's down the road, about what that can be. So I just want to make sure that that's clear for people. Now, back to your question. Yeah, there's a lot of things that people should be looking out for if they're considering a preferred equity partner. I think, first and foremost, what is the operator doing with this money? There's a lot of people out there that talk about, what's the best use of preferred equity, and really it's going to come down to that operator, what they have planned for that asset, and what their track record is, and how well they've been doing. So one kind of key takeaway that you should always be asking about is, okay, what are you going to be doing with this money? Are you going to be actually paying down the loan, which actually is going to improve? So if they say, hey, we haven't distributed, or we're not cash flow positive, well, if you pay down the loan enough, you're going to be cash flow positive, even if your occupancy or if your rents don't change. So you always kind of want to look at what that usage is. If it's something just for, oh, well, we're just paying for an interest rate cap and that's it, or we just need to, bolster only our cash reserves and nothing else, you might want to do a double check and really start asking some deeper questions with the operator to say, okay, but what's the timeline? Like, are you forcing yourself to sell like when that cash runs out and you're just waiting? Or what specifically are you trying to do with this asset that maybe we don't really understand, because you're not putting dollars directly into the bottom line, which is going to provide distributions as well as a healthier NOI, that when you do go to sell, that you're going to get a higher valuation for it.
All right. So there's, a little bit of insight into how preferred equity ties into the business plan that and what the operator is doing with this. How does an investor look at this and what the operator says, and does it align with their goals? And I'm thinking in terms of like risk tolerance, timeline, overall goals.
Yeah, absolutely. So there's a couple things here that, you need to be watching out for when you're doing this. So let's say you ask those questions already. Hey, yep, they're going to pay down the loan and that's going to make them cash flow positive. And okay, understand that, yes, maybe they do need an interest rate cap purchase, and that's going to bring them out to, let's say, 1 year. Well, it's important to understand, okay, well, when are we targeting to sell? And I need to see, a pro forma or projections that have information such as, well, what do we think is going to happen with interest rates? And therefore that's, going to come down or possibly even go up. What's happening in the competition? I'm using a multifamily example as I'm giving this. What's happening with the competition in that market? Do we see more shovels in the ground that's going to eventually, lead to lower rents for us? Basically, you need to understand that plan from that operator about what they're going to do with that cash, and what specifically is that timeline that they're looking to either sell the asset or possibly even go for a refinance if that's the case. Because if you don't have that, then it's kind of just, paying money in, but what is actually going to be that feedback? And I think that leads to another question is, inside of your portfolio, right? So your strategy of diversification, does this preferred equity actually pay out a distribution on a monthly, quarterly, or is it actually going to be accruing those distributions so that only at the time of a sale do you actually realize the return plus your capital back? So there's some pieces in there that, you see the headline, you're like, oh, preferred equity, I'm in. But then you have to drill down into those more specific pieces to understand the timeline, what the operator's thinking, and with this infusion of cash, how that's going to be better in the long run, or at least within the timeline that they're talking about.
I love that you touched on that, because that gets into kind of what you alluded to before, that there's different flavors, like different flavors of ice cream, right? Like there's different flavors of preferred equity, right? You could have a preferred equity deal that just comes in and pays 11%. You could have a preferred equity deal that comes in and pays 11%, but at the end of the sale of the asset. You could have a preferred equity deal that comes in and pays 11%, that accrues as the pref equity, guys, like the what you're owed for the sale of the asset, but then it gets a GP kicker on the backside to sweeten the deal. Is there any other deal structures that I missed here when it comes to preferred equity?
I mean, that's a majority of the ones that I think we see in the market. I mean, there's a myriad of others. I mean, there's one that actually you can go in with voting rights. Now, that's a little bit different, and that comes in more when you're talking about institutional capital or like family offices that come in, or someone that's coming in to kind of quote unquote, save a deal to actually put in that final, amount of capital that you're looking at. So there are those other different structures, but I think typically what we see and in the syndication world are kind of all of the structures that you talked about.
All right. So then if we kind of understand the structures, we understand based on the structures, you match it to your goals, risk, and timeline. Don't forget about the operator. Can the operator actually execute, right? At the end of the day, if they can't execute, that's problematic. What is the money being used for? Okay, let's talk about red flags.
Okay. So I've got a red flag. So I'll talk about this. So we at passiveinvesting.com do have a pick alliance fund. It is a preferred equity investment tool that we use with multifamilies. Our structure there is really looking at multifamilies that in reality, I think I've actually clicked it off. So they have to be well performing. They have to have good occupancy, but they also have to have an understanding of, okay, yes, you need some influx of cash for a loan down payment, or excuse me, a loan pay down. Maybe you do need help with an interest rate cap, but also let's say you've started on a renovation and you started to realize, hey, actually those renovations of those units is giving me some increases in rents that makes sense. So I say that because we have been approached by a lot of people over the past year, right? And saying, hey, I would like the Alliance Fund to come in and help me. And a couple things in there. One, they've come in and they said, hey, I've got this great plan. I've got a great asset and I just need an extra $10 million. Okay, well, take me through the details. Okay, well, I am 50% occupied. I've renovated 5 of these, let's say 100 units, and I'm getting about a 1% increase on the value. And so I just need to finish that. Well, what is the money in versus the money out? And is there actually a proven track record on those renovations? As well as what is going to do this extra money that you're going to take, this $10 million, that actually is going to help you increase your occupancy to 95 or in those 90 range, which is where we all would like to see them. So it's one of those things that a red flag to me is that if someone's coming in, they're so excited and they start naming off like low occupancies, they have a plan that they've started to implement to renovate to increase rents, but they're spending more in some cases to actually get that increase rents than the increased rents. Those are definite red flags that you need to be looking out for on those. I think the other piece is, timelines that are just kind of out there. I think if anything, over the past couple of years, we've really seen what interest rates can do. And, there's a lot of floating rate debt out there, right? And a lot of that floating rate debt has some covenants or just terms built in that, hey, you have to have an interest rate cap. Well, you need to be careful with that, because if someone comes in and they just say, hey, we're going to sell, but we're just going to wait until, the market is best. They really have to have a line in the sand on that, because guess what? That cost of capital, even if it's preferred equity and it's accruing, that's going to increase. And if they actually can't get their valuations up within a timely manner in a select timeline, that preferred equity position is going to get more and more expensive. And if they don't hit those pieces in a certain timeline, well, now you may not be actually be sitting in such a great riskless asset or riskless position than, let's say, you were before. So I think that's another red flag to make sure we understand, okay, what is that specific timeline that they're looking to actually, finish this plan and execute on that plan? Because in reality, those costs continue to build, those preferred returns continue to accrue. And what is that going to mean to the long-term effect of it?
Hmm.
I,
Yeah.
let me ask you, Whitney, because I know I've got kind of a few that are just sitting right at the top of my head. What other red flags do you see when you think about preferred equity?
Mm. I think part of it is, I think you touched on it, is, is the business plan reasonable, or is it somebody just taking the money and, trying to save a deal that probably couldn't be saved? Um, I think, for me, transparency, like, in the terms, like, how is this, the funds being put to use? Um, I think the other thing that I would encourage people to look for is there, other layers? Like if I saw a promissory note and a preferred
Yep.
equity on the same deal, I would just be like, what's going on? This is really expensive. What's going on? That would be a huge red flag for me. But I think you've touched on a majority of the red flags that I've seen. I think it all boils down to when you look at the structure and if you're thinking about investing in preferred equity, again, it goes back to any other deal. Are you in alignment with the operator? Or are you just, or are you out of alignment? Is the operator now taking and, carried interest on the preferred equity? I have never seen that before, but I'm sure somebody's done it somewhere. That just seems like, pretty bananas to me. But I want to wrap up because we were getting some questions that are coming in for our Ask Me Anything part of the show. But I want to kind of circle back to helping people think through, like, where does this fit in their portfolio given the market timing? So, help us understand the risk rewards just real quick in the different layers of the capital stack and how preferred equity, how does it take advantage of risk and reward?
Yeah, so it's a really good question. And let me just say this. So, sorry, I had a conversation with a person the other day, and they were like, "Aren't you in options in stocks?" And I'm like, "No, I'm not in options. A ton of reward, but the risk for me is just too high." So I say that because this isn't necessarily for everyone, right? And depending on what that preferred equity is, it might still not be for everyone, because in some of those deals, like we talked about, you have to completely understand what the assets are, what the overall plan is, what the timeline is, how those, if it's accruing in terms of returns, if there's a GP share that comes with it, all of those nuances that you have to know, because reality, that's going to allow you to actually think through those risk and rewards. And I think really we've seen more preferred equity kind of show up really in this time, because the traditional deals, some of them have been in hot water, right? And I think the real case is, like, for example, I think that the most general case that we're seeing right now are these floating rate loans that that they can't actually meet their debt payments, or they can't afford an interest rate cap on those pieces. And again, maybe their projections didn't anticipate one of the most accelerated increases in interest rates, over the past 30 years. But it still needs to make sense as a preferred equity person to go in there. Because again, like I said, you're not going to go throw money at a deal that's like, I'm 50% occupied. I've got this great renovation plan. I've only done 4 and I'm only getting 1% increase on rents, right? You want assets that actually still make sense, right? Because those are the assets that actually can afford a little bit more of that that cost of capital of preferred equity, and that they have a good operational plan, that, and therefore I say also, that have done it before, that have actually had that plan and it's been successful to actually carry that through. So those pieces against kind of what your risk and return are, it's not debt. Let's just be clear here. It is still equity. So if you're a very riskless person and you just say, hey, I need a monthly income and I'm not too worried about appreciation, let's say if you're retired, stick to debt. But if you say, hey, you know what, I kind of want to take advantage of the market right now and look for some, I wouldn't say outside returns, but very good returns while being in this market cycle and getting a little depreciation and some other bonuses on there, then this is something to consider. But please, I am not an advisor in any standpoint. Don't even look at my portfolio. I don't want to talk about it right now. But you need to make sure that you're thinking through, okay, if I lost all that money, what would happen? You have to be in a position that you are looking for a little bit more risk than debt, but definitely less risk than just common equity and going into a deal right now.
And I loved how you tied it back to the market cycle, because we've been having these conversations lately on the Masterclass that, when you head into hypersupply down into the recessionary environment, it's that downward curve that you have. The bank debt, the REIT debt, the insurance debt all gets sucked out of the market cycle. And that is what promissory notes is meant to take advantage of. This is what pref equity is meant to take advantage of. This is what our, the real estate debt funds are meant to take advantage of, is we as investors get to step in and solve real business problems. And you just got to know, what flavor of ice cream do you want?
Yep.
So Rob, I want to leave us plenty of time for our Ask Me Anything part of the show. As we wrap up, is there, one thing that you want to leave our investors with, and how can they reach out to you?
Absolutely. So if you have any questions about this, obviously, one, you're looking at one of your best sources right here with Whitney. Please book a call with her to understand how maybe like a pref equity could fit in to your portfolio, and again, going through all those red flags. You can also contact me. You can reach me at rob@passiveinvesting.com. And if you want to learn more, we do have a pref equity opportunity that is currently still open. It's actually going to be closing probably the first week of December. It's called the Pick Alliance Fund. And I can definitely talk you through kind of what that is and the considerations we have for that. It's a very interesting time in the market right now in terms of real estate. And if you really want to kind of stay on the cutting edge and understand all these pieces, reach out to us, have a conversation, bring a deal to discuss. Because we like talking shop. That's what we do for a living. And we're kind of, in fact, we were having dinner on Friday night and we just kept talking shop the whole time. Last time we saw each other. We love talking about this. So please reach out if you have any questions, or if you're interested in that Pick Alliance fund that we have at passiveinvesting.com.
Yes. Guys, if you're here live, don't go anywhere. We're about to start the Ask Me Anything part of our show.